In this weekend video, I'm going to show everyone just how ludicrous the idea is that stocks are in a bubble. So for the last 9 years, we've seen one analyst after another try to call a top in this bull market, and many of the are the same analysts over and over predicting the next devastating bear market. And during our recent correction, the calls for the bursting of a bubble um, reached, a seriously high level. But the idea that stocks are in a bubble is just absurd. So I think most people understand that the way long-term markets tend to work is we'll have very long-term periods of bull market. This is usually driven by a new technological advance. In the 40s and 50s into the 60s, it was plastics and electronics. From 1980 to 2000, it was the invention of the personal computer and the internet. And in between those periods of extended bull markets, you'll get a long period of sideways consolidation where uh, earnings catch up to price. Usually there'll be one, two, or three bear markets mixed in there. And then once price breaks out of that sideways consolidation, uh, then you enter another long-term bull market. So, um, a good rule of thumb is the longer a consolidation takes, the longer and deeper it is, the more powerful the rally tends to be once the breakout occurs. From 1966 to 1980, the stock market went basically nowhere. Let me switch this chart over to the Dow so you can see this. All right, so this is a very good representation of what I was talking about. So as we were coming out of the Great Recession, we had the invention of plastics and electronics during World War II. This drove a multi-year, multi-decade bull market where the market went generally upwards for many years. At some point, market becomes overvalued. The new industries are no longer new, and the world and the markets go through a consolidation phase where the gains from the previous secular bull market are digested. Earnings catch up to price, and during that period, markets just tend to go sideways for a long period of time, and you can see this very clearly here in the Dow. Topped in 66 and went absolutely nowhere until finally breaking out in 82. So this was a very long and sustained sideways churning phase. And you can see this led to a very large and sustained bull market, rallied from 82 until 2000. So now let me go back to that chart of the value line geometric index. All right, so this is this index basically measures all of the stocks in the stock market. So this index isn't overly influenced by a few leading stocks, and generally when the market breaks out of one of these long-term consolidations, the leading stocks will break out first, and that will tend to push some indexes ahead of others. But this index is a very good measure of just the average stocks in the stock market. And here you can see we topped in 98. The average stocks did not follow the tech sector up into a bubble. And we've been in this long-term sideways consolidation for most of 20 years. And in 2017, we finally broke out above this long sideways consolidation basing pattern. The recent correction, all it did was come back down to test that breakout right here. So I think everyone understands that bubbles don't occur at the beginning of a breakout from a 20-year basing pattern. They occur at the very tail end after a long multi-year, multi-decade bull market. So here was the bubble phase right here from at 95 to the top in 98, and then as we all know, the leading sector, the tech sector, just kept going higher, pushed by a few darling tech stocks, and that's the point at which the regular market topped. But the average stock topped in 98, and the average stock has been going sideways nowhere for the last 20 years until finally achieving a breakout in 2017. We've come back down to retest that breakout. And so, listening to these same analysts that have been calling a top for the last 9 years, listening to these analysts predict that a bubble is bursting is just completely absurd. You cannot have a bubble after only 1 year from a 20-year basing pattern and breakout. If we're going to have a bubble, it's either got to go, many, many degrees higher than this slight little breakout right here, or it's got 10 or 15 more years to run before we would get a final bubble phase in stocks. So do yourself a favor, ignore these people. They are going to continue to try and call a top for many years to come, and they will be just as wrong then as they have been over the last 9 years. The market is telling us and began telling us in 2017 that something has changed. The market thinks that we have new technological inventions to drive another long-term secular bull market. I don't know whether that is going to be led by biotech, nanotechnology, robotics, maybe all three, maybe something that isn't obvious at the moment, but clearly the market is seeing a driver to trigger this breakout from this 20-year consolidation basing pattern, typical of what happens once a long-term secular bull market ends, which is what happened here in 98. And we've gotten, the sideways consolidation, and now the market is trying to tell anyone that will listen that, hey, we have the drivers in place for a new secular bull market, or if we are going to get a bubble, then we've got to go a lot higher in a very short period of time before this bubble pops. Clearly, you cannot get a bubble on a very marginal breakout from a 20-year basing phase. So you just have to ignore these people. They've been wrong for the last decade, and they're going to continue to be wrong.